thank you very much for joining this session entitled Selecting a Partner and Building a Relationship, How to Effectively Incorporate ESG into the Selection, Appointment and Monitoring of Asset Managers. It follows closely on the PRI publication of 3 guides in this area, how to integrate ESG into exactly those topics, selection, appointment and monitoring, guides that you can find on our website. These guides cover those 3 areas and will be of great value and interest to both asset owners, their advisors and investment managers. I'm joined today by 4 great panelists who will talk about their own and their organization's experience in this area and tie up with some key tips for asset owners on successfully incorporating ESG into these processes. Our first panelist is Dave Zellner. Dave has been with Wespath for over 24 years and has been working in this field when I was still at school. Wespath manages the largest pool of religious assets globally and is one of the original signatories of the PRI back in 2005. I think with that, Wespath can claim to have one of the longest histories of RI integration in the US. He's joined by Sarah Bernstein from Meketa. Meketa is an independent full-service investment consulting business, working closely with clients on investment policy and design, asset allocation, risk management, manager due diligence and monitoring, as well as consulting on an alternatives investing. They've got 200 institutional clients with over 1.4 trillion in assets under management, including a number of leading lights in the RI sector in the US and North America more broadly. They're a long-standing PRI signature, and Sarah herself has 18 years of institutional investing consulting experience and is a specialist on ESG within Meketa. Gabriela Luna is joining us from Banorte. Banorte is one of the largest pension funds in Mexico with over $45 billion in assets under management, and certainly a leader in the region in terms of responsible investing with their initiatives such as their recent membership of Climate Action 100 Consortium. She's worked in their multi-investment team for over 10 years, and that's one of the key teams within Banorte as they filter, review and assess their roster of 50 third-party asset managers. And finally, we're joined by Alison Loat from OPTrust. OPTrust, as you may be aware, is a public sector fund based up in Canada. It's one of the big 10 Canadian pension plans with 22 billion Canadian assets, AUM. Again, a long-term PRI signature with an RI program dating back to 2007. Alison heads up the Sustainable Investing and Innovation team, working on climate, impact and integration. And she brings with her a cross-asset perspective, OPTrust being a big investor in alternatives. My name's Toby Belsom. I'm Director of Investor Practices at PRI and your moderator today. And my team's led on the 3 guides I mentioned earlier. Please link in with me, as that's the way I distribute a number of different PRIs or a number of different pieces of PRI's work on asset owners and more broadly. And do have a look at those guides, their selection, appointment and monitoring topics, and they'll hopefully provide you with some practical tools and guidance around RI integration in the topics we're going to discuss this afternoon. I'm pleased to have a really great panel this afternoon, and I know from our preparation in the run-up to the session we'll have a fascinating discussion. Alongside the discussion, we've got a series of audience poll questions. We'll have 3 of those as we're going along, and we'll welcome any questions which we can put to the panelists at the end of this session in the chat function. So as you're going along as audience participants, please enter those questions in the chat, and I'll come back to them after we conclude at the end if there's any that we want to cover and tie up with. We'll certainly make time for those if there are things in the chat function. So add those along. Let's start the session and move to our first topic, which is selection or search of asset managers. And as we discuss this topic, we've got an audience, or as we start to discuss this topic, we've got an audience poll, which my assistant will put it on the screen as we speak. That poll question will come on your screens for the next couple of minutes. We'd love you to answer that if possible. And effectively, the question there is what is the key step incorporating responsible investment in selecting asset managers? Those 5 or 6 different kind of MCT questions. I'll give you a minute to answer that before we take it off the screen. Interestingly, in the APAC seminar we ran last month, the answers were very similar, due diligence being the key kind of step, and in-person meetings was an important piece of the jigsaw as well. Thank you. If we could just take that off the screen, that seems to have kind of settled down. Appreciate that. We may reflect on that as we're going on. We'll start off on a discussion now. And Sarah, I'd like to turn to you first, focusing on selection. You must have a great overview coming from Meketa and your experience in terms of investment consulting on the range of approaches that various different organization and asset managers in particular approach RI, and the advice you give to clients when they come to you and say, well, how do I integrate responsible investment into the selection and search of an investment manager? And perhaps a really key, bit of advice for our audience is if you as an advisor were going to suggest one key question or key topic you think asset owners should ask their investment managers, what would that be, Sarah?
Good morning or afternoon, and thank you for hosting. So to start off, one key piece of advice, no matter what kind of organization you are, whether we consult to large public pension funds and small ones, Taft-Hartley funds, endowments, foundations, corporate funds, and every fund ends up being asset owner, ends up having their own unique approach. But throughout it all, when looking at investment managers, you want to look for and ask, when you're looking at ESG issues, how they're really integrating into their process and what the results are of those processes, to get a good sense of how environmental, social, and governance issues are affecting the financial materiality of their portfolio. I can quickly tell you what we do at Meketa if you want, or we can move on.
Oh, yeah. Well, we talked about the scoring process you use and the assessment process. Again, I think it's interesting to expand upon that to see the thought process you use within the organization.
So Meketa, thank you. We actually score managers, and not just managers that are calling themselves ESG managers, and not just managers that are thematic with a specific ESG, whether it's water or climate or social issues, but we score them. And right now the core of that is really to try and identify their process, not outcomes. So it's applicable to every single management strategy, whether they're an ESG manager or not an ESG manager. And I'm particularly talking about active management right now. And in specifically, it's fairly well developed on the public side, both for equities and listed fixed income. Private markets, the process is not as refined at this point. I would say we're evolving our own approach to both become more concrete and look for more indications of results from processes, and also to distinguish the type of goals that managers have. So broadly speaking, you can look at managers who are using ESG for financial reasons. You can see managers that are developing their strategies to both have a financial return, above market alpha and financial return, and an impact on whatever socially responsible goals they're looking at. And if a manager is identified an impact result, we're starting to look for actually quantitative results from those. So not just your financial results, but also if you really want to say you're having an impact, explain how that happens and what the results are. And I would say the industry is moving so rapidly to both develop better data and broader information across companies that we expect our processes internally to continue to evolve.
Thanks, Sarah. Dave, I think one of the topics we talked about when we were preparing for this session was around culture and tone from the top. To just maybe reflect on how important you feel that is when you're assessing an asset manager. And another aspect that we touched on was the framework. How do that's a very amorphous topic. How then do you fit that within a framework to analyze asset managers in a consistent manner as well?
Sure, Toby. Thanks for hosting, and also thanks to the PRI for inviting Wespath to share its view on manager integration, manager ESG integration. I think the one question that we would ask, if we could only ask one question, is how have you embedded consideration and integration of ESG risks and opportunities into the culture of the firm? Too often we see that there are investment managers that have appointed an individual or a team to serve as their ESG representative, and it's not, ESG culture is not embedded across the entirety of the firm. And so we want to ensure that there's a tone from the top, that the consideration of ESG risks and opportunities are an important and key integral part of investment analysis at the organization. Now at Wespath, we have what we call our sustainable economic vision, which is that we believe in order to achieve the return expectations of our participants and other stakeholders, that we need a sustainable economy, which we define as social cohesion, prosperity for all, and environmental health. And so what we're looking for is, and we realize that that's aspirational, but I haven't come across anybody who has said, well, no, if you achieve those, you're not going to get your return expectations. And so what we're looking for are investment managers that have an investment approach where they take into consideration the risks and opportunities associated with, for example, the transition to a low carbon economy, and that they're reflecting that in their investment decisions. And it's not just by relying on one or two people that fulfill an ESG role. It's embedded in the mindset and the analysis of all the securities analysts as well as the portfolio managers when they're making security selections.
Dave, you're obviously around when PRI was founded in 2006 and 2005 as a key initial signatory. Do you have any reflections on how asset managers operate more broadly from then to now, and perhaps reflecting on how Wespath's developed their own approach?
Yeah, it's interesting. After we had signed the PRI, we went to our external managers and encouraged them to look into and sign the PRI. And the pushback that we frequently got from the managers was, oh, no, I have this prudent fiduciary responsibility, and I have a lot of clients that don't want to sacrifice returns. There was this belief that to adopt ESG, the consideration of ESG factors in the investment decision process would have a negative impact on returns. We've now come to a point where there is a broad recognition that the consideration of ESG risks and opportunities actually supports the achievement of solid returns. And so we've clearly seen that organizations, and not all, we still have a number of managers that have to come along that path, but a lot of managers have made the decision that they have to consider all the risks and opportunities associated with the myriad ESG factors, not only environment, but social factors, human capital management, and other considerations. And I would say at Wespath, we've helped managers along the way understand what those issues are, what their concerns are. Our organization, there's a social principles that Wespath is the agency that manages pensions on behalf of the United Methodist clergy and lay employees. And we're asked to align our investment approach with the social principles. And what we're looking for is the intersection between the values of the church and good business practices. And so what we're frequently doing is having conversations with our investment managers regarding the key issues that we think will help lead to a sustainable economy. And as I mentioned, they are frequently coming to us for how we view addressing those issues will have an impact on achieving a sustainable economy.
And do you think the response from asset managers has changed?
Oh, definitely. There's no question about it. In fact, several of our investment managers we are now seeing participate in podcasts where they're describing for example, how they assess physical climate risks and how they take that into consideration in making investment decisions.
Thanks, Dave. Gabriela, maybe I can turn to you next. I know that Banorte's worked for a long period of time on a process about reviewing asset managers within your kind of third party asset managers, and I know you have a lot of them on the books for Banorte. Maybe you could go into some details around that process. And again, when we were talking pre this conference, you mentioned about the important role the regulator has to play in the local market and influencing your own behavior as an organization. Touch on that, because I think that'll be interesting, different insight for the participants this afternoon.
Thanks, Toby. Yeah, we implemented the process of 4 stages. First of all, our investment committee defines and approves a strategy by asset class, sector, or country. Then we search into the international and local markets, the managers who fit into this strategy. Once we have the possible managers where we want to invest, we send them an ESG and regulatory questionnaire that covers aspects like performance, governance, resources, SRI policies, exclusions policies, different matters that affects our final decisions. We manage around 100 KPIs between these 2 questionnaires. For example, we consider different aspects since climate change indicators, human resources practices, corporative conduct, compliance with concern reports, until tracking error and performance versus her peers. We evaluated also the comply with our internal and regulatory policies to exclude those who do not comply with these policies. After that, we schedule different meetings or calls in order to understand their style, their investment philosophy, how experienced they have working with these kind of strategies, how do they manage ESG risk, how do they apply the corporate governance policies. And then the result of this analysis is an internal ESG rating and an internal regulatory score, who give us the guideline to present to our investment committee the proposal of selection of an administrator. All this work, we do all this work considering a multidisciplinary team. We involve not only our portfolio managers or ESG teams, if not all the company, our legal department, our risk departments, compliance, IT, to take the best decisions according to our fiduciary duty. As you said, CONSAR has an active and relevant participation in this process. According to our regulation, CONSAR requires us an in-depth risk analysis of each manager, determining the minimum level of asset under management that the administrator must have, minimum years of experience of the team, their investment philosophy, monitoring limits, possible conflicts of interest, and obviously every year CONSAR audit our records just to be sure that we are doing our job.
Thank you. And the involvement of the regulator there is a new regulation from a Mexican context. I know will be new to many of the to the audience. Alison, if maybe I can turn to you at OPTrust. Yeah, I think again when we were talking previously, you mentioned about the developments you're working on within OPTrust, but also how important it was to integrate, the deal teams, the real investment decision makers, the teams that are selecting asset managers. But maybe expand a bit on kind of the direction you're taking within OPTrust and the principle that this should be integrated throughout the organization.
Sure. Well, thank you for having me. I've been looking forward to this. So, I mean, my predecessors have already made so many terrific points. So maybe what I'll just do is talk a little bit about sort of the cold face of trying to figure out how to implement this across an investment division. So as you mentioned in the outset, Toby, OPTrust has had a very long-standing commitment to responsible investing, dating back, I think, over 13 years, I believe is when we first developed our first proxy voting guidelines. So we've had a very well-developed process in terms of our active engagement program and our capital markets team and strategies. And then a very strong philosophy, I think, which picks up, David, on what you said of, there's an ESG person, but there's an ESG culture. So it's very clear in our statement of responsible investing principles that the responsibility for ESG, which is linked to the fiduciary duty that we all have as investors on behalf of our pensioners, that responsibility does sit at the deal team. So the sort of analogy I often use is that the sort of strength and weakness is that 1,000 flowers have bloomed. So some teams do it in some ways, some teams do it in other ways. Some teams do it less for reasons that have to do with their view on the materiality. So as the entire sort of responsible investing, sustainable investing sort of disciplines and professions evolve and become, more robust and more common practice, we're really working hard to develop a much more comprehensive program where we have the ability to sort of look and contrast and compare across the many investment strategies and teams that we do have in a way that is kind of comparable and can draw some interesting lessons where we can all learn from each other, but also relevant and practical enough for each of the individual deal teams to actually have it add value in a way that makes sense. It doesn't feel like a box checking exercise, that they really sort of strengthen their own skills and their own ability to sort of follow the industry, which is evolving so quickly. So just to kind of give a practical example of this, one of the initiatives that we led this year, the sustainable investing team led, was putting together a cross asset class team. So our public equities, fixed income, credit, real estate, private equity, and infrastructure teams all came together, and we've developed one basically approach and framework for how we integrate and assess the integration of responsible investing when we're selecting an external partner. And I could talk maybe about the specifics later if people are interested. But that's been done both for sort of external managers, public equity managers, as well as for sort of real estate funds or private equity funds or infrastructure funds. So that's really, I think, was a pretty exciting project. I tried to tell the team it was exciting. I said if we weren't remote, I would have brought cookies. But that's just an example of how we have tried to sort of bring those 1,000 flowers, so to speak, and the experience that a bunch of different teams have on the ground together to at the total fund level, so that we have a bit more of a robust and systematic approach where it makes sense, but we also are learning from each other as investors.
Thanks, Alison. I think that was a great opener, a loosener, as I say, in terms of the questions. I see there's a few questions coming in on the chat, and I know I said I was going to leave them to the end, but Sarah, I'm going to turn one to you, actually, which I think is probably most appropriate for you. There's a question there on how important you think it is on incorporating compensation KPIs within the managers, the asset managers approach, or how the KPIs compensation of individual portfolio managers is important in terms of integrating RI into that process. I wonder if you had any views on that, because you obviously again have a big reach across a range of different asset managers. Sorry, you're on mute there, Sarah. Just the beauty of conferences.
I say you're on mute is going to be the phrase of 2020.
Yeah, that's right.
Can you hear me now?
I can hear you nice and clear, Sarah. Thank you.
I think that certainly compensation is an important element of relating to the outcomes of and process of any portfolio. I guess I would just say that at the same time, you really want to balance what you're looking for and what the compensation is for. And again, going back to some of the other speakers, including Dave and Alison, and about how your overall culture is supporting the process and strategies I don't think compensation alone of an individual is end all be all of looking at what you think you might get.
Great, thank you. I know there's a few other questions coming through. We'll come to those as maybe towards the end. Alison, go on.
Well, I was just going to come in on that. And I mean, this is less about the compensation per se of a manager, but of an individual team level. One of the challenges and opportunities, I think, for sort of the ESG practitioner person in some of these funds is really about ensuring there's kind of appropriate recognition and appreciation. One thing I have observed is that very often people feel like this is kind of on the side of their job and it's not core to their job. And not everybody is this way, I know, but and often they're right that it doesn't get included in kind of their compensation frameworks. But as we sort of evolve to looking at, at least here at OPTrust, to a compensation framework where your individual investment performance matters as well as your contribution in other areas, one thing I've really tried to do this year is make sure that people's managers are aware of who's doing great work and who's taking time out of their day to really contribute to some of these projects. And to Sarah's point, there's financial compensation, but there's also other rewards that I think are important to reinforce, and for us as ESG leaders to make sure are understood. Thanks,
Alison. I think just moving on to our next question, if that first session gave us a good overview about the organization's approach, but perhaps let's drill down into asset classes, because I know you all deal with different asset classes in your kind of day-to-day role. And Dave, maybe I can turn to you first, and I'm slightly aware of this because I know you have a strong view on active versus passive, and the role that the RI incorporation plays in both. But perhaps expand upon that. And
yes, sure, Toby. Happy to. I strongly believe that we collectively as asset owners spend too much time collectively focused on alpha and not enough time focused on beta. And when you think about it, alpha is really a zero-sum game. In fact, it's a negative-sum game when you consider the impact of transaction costs and management fees. I think if we were to devote just a portion of the effort that we spend looking for alpha to focus on the market, to focus on shifting the market on the beta side of the equation, that we could exercise much more effort and achieve a lot more in terms of achieving our investment and return assumptions on behalf of our participants and other stakeholders. And this is where I think the passive players can really play a role. Their responsibility is to own the entirety of a particular index. And they can have significant influence. When you look at BlackRock and Vanguard and State Street and Fidelity, they are significant owners of corporate American securities of companies throughout the world. And so we think that they have a very major role to play in engaging with companies to adopt business policies and practices that are more aligned with a sustainable economy. And they have a pretty significant weapon that they can use when the company is not making moves to align their business practices with sustainable policies, and that is the proxy vote. There are a number of shareholder resolutions submitted every year regarding a lot of topics that and they have recently, the passive houses have got behind some of these resolutions, and you're seeing some significant movement. One of the things that I'm really proud about as far as our organization is we were the sponsor of the first resolution that was passed by U.S. U.S. and world investors of a U.S. company, and that was the climate resolution that passed with Occidental several years ago. And just recently, I think it was last week or the week before, Occidental came out and made a commitment to shift its own operations to net zero by 2040, and then completely net zero, including scope 3, by 2050. So to the extent that we can get these passive players in the market to both engage with and vote on shareholder resolutions that move us in a direction of a sustainable economy, I think we can have a greater impact. And I think we collectively, as asset owners, need to spend more time focusing on ways that we can shift public policy as well as company policy, either directly or through our passive managers, to make those changes.
Thanks, David. There's really active debate on active versus passive, and how you integrate RI into passive approaches. Gabriela, maybe I can turn to you. I know when we talked pre the event, you obviously you take a different approach to domestic investing versus international. I don't know whether you want to comment on how you approach that element of the portfolio, your domestic equities, and engage with corporates within your kind of local region.
Well, our investment process has two main pillars. The fundamental or traditional analysis, are we talking, as David said, of alpha or performance, and also the impact of the environmental, social, and governance practices in our investments. Only a global vision of the manager or issuer, going beyond the purely financial aspect and integrating all risks and opportunities, in particular for ESG criteria, allows an assessment of its intrinsic value and long-term economic performance. We manage different DDQs according to the sector, subsector, or of the manager issuer, and have analysts dedicated to covering ESG analysis, corporate governance, and in working with other 10 financial analysts to fulfill an active engagement and dialogue with local issuers or managers as part of the management policy. In particular, we talk about most controversial businesses. We assign and maintain an ESG ratings for local or for international managers. We monitor controversies and reactively assess their impact on issuers, follow track record, stay alert of new and developing ESG topics, as well as regulation that may arise, and assess possible impact on their covered industries and issuers. For our local investments, we have an active engagement with issuers of our portfolio. We are leaders implementing best practices into the evaluation of corporate decisions of the companies, analyzing ESG factors, promoting the adoption of international frameworks as Climate Action 100 Plus and TCFD. Also, we use our voice through our proxy voting policy, which is in line with our vision as a responsible investor. Furthermore, it meets the demand of a growing number of our clients who expect us to deliver long-term performance and to ensure that the environmental and social quality of the investment of our portfolio. Also, we influence corporate policies and aim to ensure consistency with the selected areas for improvement in the consideration of the investment decision in all these factors and the final decision of the managers.
Thanks, Gabriela. That's a good overview and difference between the two approaches you take. Alison, I know OPTrust is a big alternatives investor. I wonder how you kind of approach that asset class, or how you vary the approach on selecting third-party managers depending on asset classes, or how you're thinking about that process anyway.
Sure. Well, as I mentioned at the outset, we've actually developed this sort of cross-fund framework that is meant to sort of work for everyone, but obviously has a component in it where teams will sort of adjust it based on the criteria that matter most to that asset class. So, I mean, broadly speaking, all teams look at will start to, as we roll it out, look at 4 sort of broad categories. And again, we've got lists under each of these categories, but the first one is the RI governance and sort of staffing. So trying to understand, again, to go back to David's kind of how they approach this, what their policies, if they have them, what they say, what they do. The second is looking at their RI integration. So that's really actually how do they incorporate that when they're making investment decisions on our behalf. The third is their sort of active stewardship or their monitoring once they make those investments. And then the fourth one is how they sort of report and communicate back more broadly, and then also back to us, including vis-a-vis incidents that might occur of a material nature. So, I mean, that's at a very high level how we do that. So that's applied across all of our funds and or external manager selections. That said, in our alternatives business, a fair chunk of that is direct investing. So that a little separate, I know, than the topic today. So that's where, again, we're developing out slightly different approaches for our infrastructure and private equity. And we haven't yet done much with our real estate colleagues, but that will be starting next year. So that one is very different, because often when we make a direct investment, we have a much more substantial ownership stake and more of a voice. So that obviously changes our strategy and our ability to the way that we both analyze, but also sort of actively manage and steward that asset, usually as part of a board or some kind of a governance structure. So it's quite different than sort of being one of many in a externally managed fund, for example. I see there's a couple of other questions as well about sort of ratings and things. I don't know if you want to, I could pick up on a couple of those, or if you want to come back to those.
I think we'll move on to the next area, but two of the questions, again, I was going to kind of point to you, Sarah, if that was okay. One was on the role that ESG ratings or fund ratings play within the process, and your view on those as a mechanism for asset managers to differentiate between as a mechanism for asset owners, rather, to differentiate between asset managers, and also whether you had any view on short selling with respect to ESG. So two very different questions. I wondered whether you had any views on either of those, really.
Sure. So on the role of scores, ESG ratings by major ESG data vendors, we're not really using those as distinguishers. And really, I think you need to look at actual data and look at the managers, mainly because when you roll up all of the different vendors, and I know you all are familiar with the differences, but the lack of standards and the opaqueness of the various ratings don't lend themselves to giving us a good sense of on the ground of what a particular manager is doing. And if I want to move on to the short selling, there are certainly, even in each area, I'm thinking of one in particular in climate, that is successfully shorting securities to get a higher return based on the same issues that we're all looking at. So I don't think I don't think derivatives, I think and long and short strategies they weren't the beginning of where ESG was integrated, but they're certainly becoming more of a factor, and I think will evolve in that, even in this decade, to be additional strategies that clearly on the engagement and voting side, you'll think about and use them differently than you would long equity portfolios. But
thank you. It's nice, quick answers. I wanted to move on to the next poll question, actually, for the audience, and that was on the appointment process. So you kind of selected, we talked about different mechanisms on searching and selecting for asset managers. This one's on the appointment phase, and the question is around what stops ESG from being included in legal contracts between asset owners and asset managers. So if you could answer that in terms of the audience, that'd be brilliant. I'm sure there'll be a few different perceptions around that. And very interesting, almost balance between misconceptions, perceived issues around materiality, and perceived issues around fiduciary duty. Good. Okay. Thank you. Dave, kind of turning to you on this one. I don't know whether you have, having been a long-standing or having a very long-standing RI policy and some clear mandate from the assets that you manage, as it were, whether you incorporate ESG issues into the legal framework you have with asset owners.
The only thing that we include in our legal framework is a provision requiring formal acknowledgement and adherence to our ethical exclusion policy. Now, I'm going to go on another rant and say that I think that ethical exclusions, and of course, like any religious institution you might expect, we exclude alcohol, tobacco, gambling, etc. But I'm not going to claim ESG integration by saying that we're excluding tobacco, alcohol. That's a completely separate element of our program, and it's to align with the values of the church. But as far as the extent to which a institution, an asset manager, has to integrate ESG in their consideration process, that's just a part of our due diligence process. We don't have any specific provisions in our legal documents. We do have annual reporting where we ask a number of questions. Not only we have our due diligence questionnaire that we go through when we're considering hiring an investment manager. When we're doing on-site due diligence, or in this day and age, virtual due diligence, we'll certainly ask questions to validate the answers that they provided on their due diligence questionnaires. And then on an ongoing basis, and I know we're going to talk about monitoring a little bit later, we validate that what they told us in the interview process and the due diligence process that they're continuing to do. But I have not identified any specific needs to include provisions in our contracts requiring the consideration of ESG factors. Just as I don't include provisions in the contracts that require that they assess the quality of management or a company's product pipeline or other business type risks.
Thanks, Dave. Sarah, I know when we were talking about this, we talked about the important role that the mandate has to play in this process, and that it was an evolving field. There were people starting to think about this possibly, but still not a widespread practice.
Yeah, and I would agree with what Dave's saying, but I'm also seeing, particularly on climate issues, evolution to really start potentially including in investment mandates specific criteria, for example, for meeting, net zero, and once they're defined, targets and where you are, so that it's on that are trying to be consistent with those kind of policies of an asset owner. My guess is that kind of detail may well become more and more used over the next decade, I would say.
Thanks, Sarah. Alison and Gabriela, I know we talked about and touched on the importance of the IMA as a tool for that. And Alison, I know it was more about a relationship, and you have to learn with your asset management that you've selected rather than setting down the framework within a legal structure. I don't know whether Edith, if you had something to add on that discussion.
Yeah, Toby, as I mentioned before, we set up an ESG policy that takes into account ESG factors in addition to financial factors across our active investment managers' strategies, and that includes an exclusion and an engagement policy. Currently, we include an inclusion list by sector on our IMAs according to our glide path, which is also available on our webpage. Our exclusion rules apply to all our strategies, since active, stop picking local investments until passive strategies with our external managers. At this moment, we include in this list, for example, companies who are involved in the production or sale of anti-personnel mines or cluster munitions, businesses that produce or sell chemical, biological weapons, companies that seriously violate one of or more of the 10 UN Global Compact principles. And additionally, we have several calls with our managers where they present to us every quarter the results of their performance and ESG KPIs. These KPIs considers the integration of ESG analysis into their investment decisions, corporate governance, ESG teams, proxy voting processes. And finally, we also recently defined an internal strategy to mitigate climate change in our real estate investments, which considers 8 goals such as carbon footprint, ESG policy, sustainable buildings, risk management, etc.
Thanks, Gabriela. I think that brings us on to the final session, or the final kind of question really, which is regarding the monitoring process. And again, we've got a little bit of a poll there that we wanted the audience to answer. If you could bring that up now, that'd be brilliant. Thank you. And the question was around what would improve your ability to monitor your asset managers. And again, if you could answer that just for a minute or two, and then we'll go on to the questions. I'm keen that we tie up and give plenty of time for our final question, which was one piece of advice from the panelists to the audience. So we want to leave plenty of time for that. Thank you. But fairly balanced, interesting. In fact, no clear winner in that. So targets and reporting being possible, and verification being a key one there. Thank you. If you could take that off the screen. Dave, maybe again, kind of turn to you, and again, you've clearly been monitoring asset managers for a long period of time, and have a well-developed, mature process. But perhaps give us a quick outline of what that process is, and where you think it works, or why you think it works.
Sure. Yeah, Toby. So as I mentioned earlier, we have an annual questionnaire that we ask each of our managers to complete. And then after we review the questionnaire, we want to validate the responses by getting the manager on the phone or in person and just start asking questions regarding some of the responses that they gave. And we have a number of criteria that we use to evaluate the managers, and we've developed this matrix where we rate each one of the managers on each one of the specific criteria that we include in our evaluation process. And so that what we end up doing is we develop an aggregate score for that manager, and then we rank order all of the managers, comparing them to each other. And then so we put them, we publish this, we internally publish the matrix, listing from the left managers that are leaders, and to the right, the managers are laggards. And then what we do is we sit down with each one of the managers and we show them where they show up in terms of the rating. We hide the names of the other managers, but we'll show where they align on this array of leaders to laggards. And the reality is that asset managers are a very competitive lot. And when they see that they're in the laggard camp, they certainly want to know what is it that they need to do to improve their ranking. And then we have a really robust discussion on what we see as best practices from some of the other asset managers. And we have seen over the years that it has resulted in improvement in terms of the asset owner integrating best practices to their ESG integration.
Thanks, David. Kind of really clear overview. Gabriela, kind of turning to you. I know you mentioned perhaps some of the monitoring processes just earlier on, but I wonder whether there's anything else you wanted to add in terms of requiring managers to report on proxy votes and on specific ESG controversies as well. I remember us talking about that pre this event.
Yeah, well, we have different analysts by sector that are analyzing every quarter the financial statements of our local investment or the alpha of our managers. And we send every 6 months a questionnaire with ESG topics and require them to reveal the most important ESG risk or controversies that face our portfolio. We manage around 12 ESG indicators that consider, between others, corporate governance practices, how do they use our voice, the ESG team experience, the organizational bodies that monitor and control policies and processes, manager strategy, etc. Okay. Also, we schedule different calls with them to understand the macroeconomic, social, environmental themes, and according to our fiduciary duty, we exercise our responsibility as an investor in the following areas, like shareholder dialogue with companies, the consideration in investment decision of ESG factors, the policy, the voting policy, and through which we influence corporate policies and aim to ensure consistency with the select areas for improvement.
Thanks, Gabriela. Sarah, I mean, monitoring fund managers must be a kind of almost continuous task for you. And maybe expand a bit on the KPIs you use and the advice you give to managers on monitoring the advice you give to asset owners rather on monitoring managers.
Thank you. Yeah, so and within the ESG, I mean, obviously all the managers get monitored and quarterly reported on from a standard performance and risk perspective. From ESG perspective, it really depends on the client and what they're doing at this point. Many of them are developing annual due diligence questionnaires specifically on ESG questions and then following up on those. And we'll be following up with managers on if questions arise. And more recently, I think we're starting to see ESG key performance indicators be looked at as potential ways to monitor the overall portfolio, and then individually managers compared to benchmarks underneath that. I guess one element of that seems to be emerging is actually at some point looking at managers the same way you would on performance metrics for potentially putting them on watch for overall mandate compliance, including various ESG factors. And we talked earlier about the difference in the public markets about active versus passive managers. On the passive side, the due diligence there is really on their voting record and also on their engagement. And I'm finding that 5 years ago would not have even been a question or a thought for most of our clients. And today, because they often have a lot of their assets with their passive managers, want to know, and often in their commingled funds where the plan is not, the asset owner is not controlling the votes as they would in a separate account.
Thank you, Sarah. I'm slightly wary of the time. We've got a couple of minutes left. I wanted to tie up with just if the panelists were to give one piece of advice to fellow asset owners about starting this process or moving it along a bit, what would that one single piece of advice be? And in fact, it reflects one of the questions in the chat function as we've been going along. And apologies if I've not managed to answer all those chat functions or all those chat questions in their entirety. Alison, maybe I could turn to you on what your key bit of advice would be.
I mean, overall, it depends on the audience. I'll answer the question. I just want to make a point about what was just discussed about the monitoring, and then I'll answer the question. So, not knowing who's on the line exactly, we're a smaller fund and we invest heavily in the mid-market and often with kind of less newer managers. So, one thing on all of this scoring that I'm always really sensitive to is that when you're investing with a smaller or sort of newer manager, they may not have the same as a kind of big and established one. So that'll kind of get me to the advice, which is, I know often boards, trustees, management, the tone they set is absolutely critical, of course. Often, and I think I speak for many of my colleagues in the responsible investing space, it can be very challenging when sort of declarations get made or statements get made, and the work hasn't been done to kind of think through at the individual sort of investment decision level, how do we support and help all of those people actually sort of make that real for them in a day-to-day way, in a way that doesn't feel like a box tick, doesn't feel like a box tick to our partners, because I think probably I'm not alone that one of the number one frustrations I think asset managers have when dealing with owners is like, here's another DDQ and here's a survey, and then I never hear from you again. So really being practical from, the sort of aspirational statement and tone, which is so critical, but really thinking and working, almost from a bottom up way as well to help and support the teams in what this really means for them. So that doesn't just sound like marketing materials, and that it feels like it's really helps in the materiality of the decision making that those individual investment teams are making.
And your kind of, I don't know whether the single piece of advice was within that or.
Yeah, I mean, I think often the declarations get made, absent a really concrete consideration of what investment teams are being asked to do. So I mentioned the kind of newer funds or smaller funds or mid-market partners. They don't have, some of these people don't have massive teams, and we're investing with them because they think they give us a unique investment strategy in the overall market. And to expect that they're going to get the same score as, name your very well-established public equities manager, is unrealistic. And so often how things get felt at the level of the investment professional is that I'm not allowed to do this anymore, or I'm going to get in trouble if I do this and make this investment. And that's certainly not the sort of tone that anyone intends, but it's often sort of the byproduct of when, the tone that's set from the top and the kind of day-to-day work are not connected. So I think probably the advice is just take that extra time to make sure that the voice of the frontline investor is sort of considered and pushed forward, of course, at the same time that, you want to set the right sort of tone and aspirations at the top.
Thanks, Alison. That's a really good kind of tip for the audience listening. Gabriela, we kind of talked about, taking that first step and almost with a leap of faith in a way. Maybe expand about what your key bit of advice would be to asset owners.
Yeah, just a simple advice, as you said, Toby, make the first step. No, this is a long way, but we need to react and be active, not passive in the adoption of ESG factors.
Thank you. Nice and straightforward and simple. Sarah, turning to you, again, you deal with a lot of different clients. Well, what's the single really key bit of advice you give to them?
Sort of be true to your own, develop it out of your own perspective. Each client is unique. And second, don't start or not start because you don't know all the answers. Anticipate that you're going to change your role and maybe start small and move from there if you haven't really started. Anticipate that you will develop your perspective on ESG and how to integrate it throughout the years.
Good, thank you, Dave.
Yeah, I think the advice that from the other panelists is all very good. I think if an asset owner or a trustee had asked me, we want to go into ESG in a big way. How should we go about doing that? And I think that Barbara Svan she's the newly appointed CEO of the new Canadian University Pension Plan. I think she modeled the best advice that I might offer. And even though she's a very knowledgeable expert about ESG integration, she commissioned a consulting firm to arrange calls with about a dozen leading asset owners to understand how they assess ESG risks and opportunities. And she charged the consultants with assembling a document describing the best practices employed by those asset owners that she's going to use as a playbook for building her own team's ESG competencies.
Thank you. That was a really great kind of session that we've just had on covering a whole range of different topics around selection, appointment, and monitoring of asset managers, and how asset owners can start to think about responsible investment and integrating it into that process. PRI has done a lot of work on this topic, and that's culminated, or one of the recent high points of that, certainly within my team's scope, was the publication of our guides on selection, appointment, and monitoring. And I would advise you to go and have a look at those, because they provide a very good overview on this process. I think all that it leaves me to do is thank the panelists, Sarah, Dave, Alison and Gabriela for a very entertaining and really informative last hour. I know that the digital forum is continuing, so if you want to return to the live stream, and we'll call this session to an end. Thank you very much, panelists. Much appreciated. Great input, and thank you very much for the audience as well, for answering the polls and some great questions, which we'll try and answer offline if we've left any unanswered. Thank you very much, and please return to the live stream.